All right, ladies and gentlemen, it's Aaron Fragnito here with People's Capital Group. Welcome to our presentation tonight. I see more people are jumping on. Always good to see good attendance here on our live webinars. Here at People's Capital Group, we do a number of live webinars every month. Next week, we have a presentation about inflation and the state of the market, which we've done live in our office now a couple times, but a lot of people can't make the live events for logistical reasons, so we understand that. So we're now bringing that presentation on a webinar format. That's going to happen next week. This week, we're talking about live update here, People's Capital Group apartment building repositions. So tonight, we're going to talk about current properties we are repositioning in New Jersey, apartment buildings that passive investors have invested capital into, and People's Capital Group renovates them and manages them better and leases them for top dollar so that we can produce cash flow and top value for our investors through a cash out refinance strategy. So we're going to break into all that tonight. We're going to talk a little bit about our strategy, why and how we do the cash out refinance, and we're going to do that through case studies. So we'll talk about two current case studies and also two updates on properties as well. So we'll dig into two properties a little bit further, and then we'll do more of a 30,000-foot view on two other properties tonight. Quick disclaimer, this is not a solicitation for funds. This is not tax advice or legal advice. This is for informational purposes only. And again, this is just about what we're doing right now with qualified investors. If you do feel like this is a fit for your investment goals, you want to go to peoplescapitalgroup.com, enjoy our podcasts, past webinars, weekly blogs as well, and tons of content on our website there, peoplescapitalgroup.com. Maybe you're part of our meetup group of 4,000 members. Maybe you've been following us for some of the last decade that we've been helping people invest in real estate, or maybe you just found us online recently. So either way, we're glad you can join us here. Let's get started. All right, so here's our properties we're going to focus on tonight. We have a case study number one, 463-465 Summer Street in Patterson, New Jersey. We focused on that last quarter as well. We're going to give you an update on that property. Things are going quite well. We'll do another case study. We'll dig into 196 9th Street, Passaic, New Jersey. And again, this is a property, if you joined us last quarter, then you've been following these properties, and now we actually are just refinancing that property 2 years ahead of schedule. So I'll explain what that means and why that is good for our investors. I'll do a quick update on 105 Marion Street in Patterson, New Jersey, a 25 unit we bought a little over a year ago, and also a update on 421 Central Avenue, Newark, New Jersey. That's a big renovation, more of a complete renovation job there, where Marion Street is more of a turnkey property. So we'll talk about the differences there and how those differ for our passive investors. And but 421 Central Avenue, Newark was a big renovation. We're ahead of schedule there. We're looking really nice. And I'm also going to touch on the 27 unit we just bought in Rahway, New Jersey, just because I have good news there also. So we're going to talk about that one, although it's not quite on the list here. I'll just talk about that one separately. All right, so let's break into it here. So now, if you have any questions as we go along, I encourage you to type the questions in the Q&A. So it's the best thing to do. I'm going to answer all questions at the end. That way we don't get distracted here. But again, I really enjoy questions. I enjoy engaging the viewers here. I see more people are jumping on, which is always good to see. This will also be live on our Facebook group and our Facebook page. If you haven't checked us out there, we're Real Estate Investments on Facebook. And we also have a private group you can join as well. But you can learn more about us at peoplescapitalgroup.com. All right, let's get into this process here, how it works. All right, so let's first talk about how do we buy, renovate, and refinance apartment buildings, and how does that produce value for our passive investor group? Well, the first step is finding a good property, right? Finding a good property for a good price. We look for value add properties. That means we're looking for properties that we can increase the performance of by putting physical renovations into the property, renegotiating the leases for top dollar, releasing vacant units after renovation for top dollar, or working with current tenants to negotiate their leases up for renovations as well, or doing cash for keys with existing tenants that are at a very low rental amount and having an amicable exit for them, and making the building a nice place to live that looks nice and smells nice, and people are proud to live there and happy to pay their rent on time. The management company answers your call. They get the plumbers and electricians and contractors out there quickly to fix problems. And when you move into the building, you have a nice experience as well, understanding you're working with a professional management company, as we have here at People's Capital Group. We have our own in-house management company, and that allows us to manage our buildings very closely. So the first thing we try to do is find a discounted property for sale, generally within a few blocks of a train station that gets you to Manhattan, or just a downtown area. We try to focus on, we've been very active in Jersey City, Patterson, Newark, Morristown, Plainfield. Through the years, we've bought all throughout Essex and Union County and Hudson County and Passaic County as well. So we really focus on North Jersey here. We have a very specific niche. We find mismanaged apartment buildings, buy them for a great price, improve the performance of the building, and do a cash out refinance over time to harvest that equity growth and split up a large lump sum with our investor group. And of course, there's exit options of the refinance as well for our investors. So step two is we want to improve those units, increase the rent, lower our expenses. We put physical improvements into the property, and that allows us to charge more for rent. And of course, the more the building makes, the higher the net operating income of a building is, the more the value of the building is worth. Okay, so the more a building makes, the higher the net operating income is on the building. As we increase that, we increase the value of the building, and allows us to force the value up on the building. That's called forced equity, and that's our goal, is to find a value add property that has room to improve. We buy the building, we force equity into it through improved management and renovations of the property. And in step three, once we have positive cash flow from the building, we've completed our renovations and we've leased it up for top dollar, we go to refinance the building. Now it's going to appraise at a much higher price. We can harvest that equity growth and do a cash out refinance from the building, where our investors would expect about half of their investment back. Now, we normally allocate about a 5-year period to do this whole thing, do this whole reposition of an apartment building. But we are now achieving this much faster, generally in about a 3 to 4 year period, which means our investors are getting stronger returns faster. So that's good for everyone. Okay, also, if we have any technical difficulties as we go along here, please let me know. You can type in the Q&A if you can't hear me or see me for some reason. Hopefully my internet connection is strong here. So here's our team at People's Capital Group. We developed our own management company, PCG Property Management. See, when Seth and I got to around 75 units or so in 2015, we had fired 2 management companies. Neither one of them were doing the job. I think actually we had fired a third one then as we started our own management company. And we realized that management is the most important thing when you're buying and repositioning apartment buildings, or really doing any type of real estate. You can make good returns in real estate in Texas or Florida or New Jersey or California. There's tons of different types of buildings to buy. Mobile homes, warehouses, apartment buildings, mixed use, office space. There's lots of ways to make money in real estate, but the bottom line is you want the right operators operating the building that are experienced in that market and in that type of real estate. So we don't manage real estate for anyone else. We are laser focused on managing our own buildings, getting top performance out of them, and managing them also for a discounted management fee as well. There's Seth Martinez to the left. He's in charge of acquisitions, due diligence, overseeing our management company, and general company oversight as well. There's me, Aaron Fragnito. I'm more on the investor relations side. I also complete due diligence on the properties as well, once Seth completes his and brings me the preferred deals. I'm in charge of marketing and branding and fundraising as well. We try to fund our deals generally in about a 1 to 4 week period. Often our deals are overfunded. So if you do enjoy what we're talking about here, you feel like this is a fit for your investment goals, you want to get on that list sooner than later. And that all starts at peoplescapitalgroup.com, where you fill out a qualification form and see if you can get qualified to become a passive investor. But that's my job, to focus on connecting with investors, offering monthly updates, quarterly financials, and that way we are very transparent to our investors so they know exactly what's going on with their investment, exactly what's going on with each property they're invested in. And we explain the good, the bad, the ugly. And a lot of people learn from our updates as well. That's something we're very proud of as well. Lena Delgado is our secret sauce. She's amazing. She does the property management behind the scenes. She manages our property management staff there. She does our leasing as well to make sure we're bringing in great tenants, the best quality tenants. See, another tip to property management is making sure you're leasing to the right tenants. I'd rather wait a week or two or even a month and have my property sit there vacant as I get the right tenant rather than lease to the first person who fills out an application. The best option is when you have 30 people line up at the open house and 8 applications, and you can select the best one and move the second and third best applications to other vacant units. And we just did that with a 27 unit in Rahway, New Jersey. We did a great renovation there. The demand for it was very high. We had a line out the door to lease the unit and a number of strong applicants. So we were allowed to lease additional units from that one open house. Great experience there, great investment. That's in Rahway, New Jersey, going quite well. Here's Robert Grulich to the right, our CPA. He's in charge of accounting, tax filing, tax preparation, and he also sends a bookkeeper to our office twice a week, Christy Churchill, who's great at what she does and does all of our bookkeeping. So that's a whole third party. They do all of our tax prep. They do all of our bookkeeping. Nice separation of powers by having a third party CPA firm do all the tax prep, all the financials, so our investors get their K1s in a timely manner. They get their financials at the end of the quarter in a timely manner. And of course, our checks are cut when there's positive cash flow as well in a timely manner. So let's break into our first deal here. I see more people are jumping on, which is great to see. Again, if you have any questions, you can put that in the Q&A. I encourage questions as we go along here. So here's our first case study, 463-465 Summer Street in Patterson, New Jersey. So this property we actually had bought this from a private owner. And we always say great deals are created, they're not found. Right? So that means when we make a deal happen, we're creating the deal. We are generally building a relationship with a landlord or a broker. We are working those relationships for many years. So just as people invest in us and then invest again and again and again for years to come as we outperform our targets. Same thing with landlords or brokers or wholesalers. If we perform on purchasing a building through them or a building they own, then they like us and they see that we're the real deal. So they bring us their next deal first. In this case, we were doing direct mail marketing. So this was a new contact, a new relationship, and it took Seth a long time to build this relationship. He does very good at building rapport with owners, but it's a very patient process and it takes a lot of time. And this is an older gentleman who was very difficult to negotiate with and did not make it easy to close. He had a little title issue he didn't want to fix and was trying to push it off on us, but we negotiated to a good price. And, at first he wanted a high price, but we got him down to a really good price, I think at $950,000. So that allowed us to get him from a much higher price than that down to a good price by building rapport, showing that we have value, and also just kind of slow walking the relationship so that when he was ready to sell, he sold us the building for a great price. So Seth negotiated that price down. There were some caveats with the deal. Of course, with any fixer-upper, you're going to have some challenges here. So there was no green card. Okay, that's a state card. That's a state inspection that happens every 5 years for units for buildings 3 units or larger. If you don't know what a green card is and you own multifamilies in New Jersey, I would definitely suggest Googling that and learning more about it. Essentially, the state can enforce these inspections on properties 3 units or larger. And they can do this every 5 years. They can fine you without notifying you if you're the owner of the property, if you're not getting that inspection every 5 years. And they can come out to the property without telling you. And if you're not there just by chance to let them in, they can fine you as well. It's a kind of backwards system. It's not really fair to the landlords. They're not easy to negotiate with. They're not easy to communicate with. But that's enforced here in New Jersey. So if you own a multifamily property, 3 units or larger, you really have to understand, do you have a green card? Is the state fining you for not having a green card right now? We bought a building one time and we finally got a hold of the green card part. This is years ago, and how we learned this lesson actually. And there was $20,000 in fees due from the last owner because he never got a green card, and the state wanted us to pay those $20,000. We actually had to hire an attorney and get that negotiated, and we only were able to get it negotiated in half because it's a crazy situation here where they can enforce fees from last owners if they want to, essentially. So it's tough dealing with the green card, tough dealing with the state. You got to know how to navigate with them and be aware of your situation with your state green card. The property had low rents, it needed work, outdated units, kind of a bit of a slumlord owned it before here. So he really didn't take care of the building the right way or take care of the tenants the right way. We always say a happy tenant equals a happy investor. It starts with putting in a good tenant, treating them right, creating a nice environment for them to live in, and treating people who you do business with the way you'd want to be treated. Right? The golden rule, of course. So we reflect that through all of our business dealings, whether you are investing with us, whether you are one of our tenants or one of our contractors or service providers. We work with people every day, hundreds of them, and all different types of people all through the spectrum. And it's important to treat everyone with respect and courtesy, but especially our tenants, because a happy tenant pays their rent on time, takes care of the unit, works with you when it's time to move out or fix something or negotiate a higher rent amount. So a happy tenant equals a happy investor, and that's our motto here at People's Capital Group. This is 10 apartments and 1 storefront, so a small mixed-use property. This is a mixed-use property. You see here on the left, that's we bought the building with a lot of graffiti on it and just needed a paint job on the front there. Also, the bricks were kind of messy, so we had them power washed as well. And actually, you can update a picture of the power washed up front. It looks very nice. But here's our acquisition structure. In this case, we actually own the majority, which is not very, I'm sorry, we owned 42% here. That's the next deal. 58% was owned by passive investors, non-voting members, okay? 42 was owned by People's Capital Group. Now, on larger buildings, it's People's Capital Group and the investors tend to own more. In this case, the building was a bigger project and the numbers panned out as such that the investors own 58%. We have deals right now where investors are owning more like 66% or so, and People's Capital Group owning a third. For larger properties, that's more common. But in this case, this was the split. And it looks like we're going to be able to perform very well in this property. We raised about $406,000 for this property. We created a Reg D 506B with the SEC. That means we were allowed to accept sophisticated and accredited investors. All right, so there's 2 ways that our real estate syndicate here, People's Capital Group, really differs from a lot of the competition. First of all, we have an in-house management company that is laser focused on repositioning North Jersey apartment buildings. And that's what we focus on. That's our specialty. That's what we're good at. That's where our historical track record shows we perform very well. And that's what we do here at People's Capital Group. And our management company is positioned just to do that exact task. The second thing that sets us apart from other real estate syndicators, as far as I can see, is that we accept sophisticated investors. Right? Not just accredited investors. That means that if you are not yet accredited, okay, an accredited investor is someone that has a net worth of $250,000 or a combined household income of $300,000, or they have they have an income of $250,000 or a total household income of $300,000, or they have a net worth of $1 million, not including their primary residence. You qualify as an accredited investor. If you don't quite meet that position, then most likely you would not qualify to invest in what I can see 90% of real estate funds out there. Most real estate syndicates only accept accredited investors because, quite frankly, there's less risk working with them on our end. It's easier to do it. You can just send out an email blast with the deal. You can advertise a deal. We have to be a little more careful with that, so we create a 506B that allows us to accept sophisticated investors, but in turn, there's more restrictions on how we can market the deal. Now, sophisticated investors are not yet accredited investors, okay? Ideally, they have some experience in real estate investing. Maybe they own a home or they own an income property. They have the minimum investment of $30,000 plus excess savings. They have ample income coming in, and they understand the investment opportunity, meaning they've reviewed the offer memorandum, they fill out the qualification form, and they've had their discovery call, and they're qualified through all those measures. So if you make the cut there as a sophisticated investor, that opens up the door for beginning investors, smaller investors, people that are not millionaires, which are accredited investors. So a 506B allows us to work with more people. And quite frankly, people getting started more so in real estate that are looking to make a smaller investment amount of $30,000, but get into a multi-million-dollar building, where normally a $30,000 investment would not allow you to get into a multi-million-dollar building. Now, most of our accredited investors are investing over $100,000 per opportunity. Most of our sophisticated investors are investing about $30,000 to $50,000 per opportunity. And our next opportunity, we're actually going to have different share classes rewarding a larger investment. We often do something like that with our investments right now, but it'll be a little more clear for future investments as well. So in this case, we got a mortgage amount of $723,000. We did have to personally guarantee the debt, so our investors don't have to. We signed for the mortgage, so our investors don't have to. That makes sure that we get good terms on the loan, and also takes a lot of risk off the investor's shoulders as well. So here's our timeline to close and reposition this building, Summer Street in Paterson, New Jersey. So the project is ahead of schedule. We actually plan on refinancing the building at the end of this year, which would put us in a refinance about 2 years ahead of schedule. So things are going quite well, but here's how it started. January 2019, Seth connected with the owner and built rapport. So again, it took Seth a number of months to connect with the owner. We spend thousands of dollars on direct mail marketing. It really doesn't work anymore. That really was in around 2017 to 2018. This gentleman was probably getting those letters. It did work pretty well back then. It doesn't work anymore. I wouldn't suggest doing that. So we were able to send this gentleman probably about 8 or 9 letters, right? So the marketing strategy didn't start in January 2019. It probably started around 2017, quite frankly. And after a number of letters and contacting them and Seth building rapport and building trust and building a relationship with this landlord, 6 months later, July 2019, the seller signed a purchase contract with Seth for $965,000, which for an 11 unit in Patterson, New Jersey, decent part of Patterson, not far from the downtown area there, is a good price. A good price. It'll probably appraise for twice that, ideally by the end of this year. That's our goal. And so in this case, that was July 2019. Okay, so here's then June 2020. Right? So practically a whole year later, after delays from the seller's title issue, PCG closed on the property. Now, I like doing this case study because it shows behind the scenes how difficult this stuff is. Now, when we are closing on a property, our job is to make sure that everything is lined up properly, that we've done our due diligence, it's a good investment. Sure, there's going to be challenges, repairs, non-cooperative tenants, right? We're ready for that. We worked that all into the numbers. That's just part of the project. But in this case, there was a title issue. The owner had transferred the title to his ex-wife's name in an attempt to avoid to pay like 20 grand of back taxes. And then when he went to sell it, the property wasn't in his name. So he had to get it pushed back over. And then apparently the title issue came up then with the back taxes that were owed. So he tried to have us pay the back taxes. We were adamant that we were not going to do that. And it took about a year of a staring contest to get him to agree that he's going to pay his own back taxes. So finally, a year later, just about, we closed on the property. And so July 2020, then we begin repositioning the property, and it's about a 2 to 3 year renovation strategy. See, the property was basically fully occupied when we bought it. So we had to work out cash for keys with certain tenants that were paying very low, below market value. For tenants that were paying close to market value, but just needed about a 15% increase or so, we were able to work with a lot of those tenants and kind of spruce up the units around them and then renegotiate to a higher lease amount. We had other tenants that moved out of the property, and then that allowed us to have a vacant unit that's much easier to renovate, much easier to increase rent and release for top dollar. So we had a combination of all that, and we were able to renovate the property here and get it leased up for top dollar. And our reposition now, March 2022 here, we are ahead of schedule. We are nearly complete with our leasing our last unit here. And we had some challenges, right? We had a pandemic that came. I'm sure you heard about that. We had Hurricane Ida cause challenges here, caused some flooding. It's not in a flood zone, but Hurricane Ida got some water in the basement. We lost some boilers. People's Capital Group had to put in additional capital from our pocket to cover that boiler cost because it's an unforeseen issue. And it's our agreement that unforeseen costs like that, it's our job to cover those costs if we've exhausted the repair budget. So in this case, we came out of pocket for additional heaters after there was flood damage to make sure we never go back to our investors to raise more capital. We never do a cash call. And of course, in this case, when we had water damage in the basement, we ended up fixing it ourselves with our own capital, or our own contractors, of course. And that's our promise to our investors. And the property still is set to perform ahead of schedule, still set to refinance successfully here by the end of this year. And that's going to allow us to refinance ideally about 2 years ahead of schedule. So our investors should make a return ideally far better than targeted here on this property. So here you can see on the far right, that's how we did the kitchens. We put in granite countertops, kind of spruced them up, but just a basic renovation there. So our initial rent roll was $10,900. Our target rent roll after year 3 is $13,800. Our current rent roll after year 1 was $12,700. The construction budget was $96,500. So you can see here after year 1, we were very aggressive coming in. We were able to achieve about 2/3 of our rental growth after year 1. It did take us another 2 years to deal with the last few tenants. We had some uncooperative tenants. Eviction court was closed. That was challenging, but now we're back on track, and we're able to now bring rents up to the target amount here. So we've achieved our target rent now as we lease the last unit. We're slightly over construction because of the water damage to the basement from Hurricane Ida. And we assumed a 5% annual forced equity growth. We targeted, 5%. We assumed the market would grow, or our annual forced equity, the amount of equity we control by renovations and releasing the building for top dollar. We assumed it would be about 5% per year. We've actually done far better than that. We also assumed a very conservative 1.5% natural market appreciation. Values have grown a lot more than 1.5% a year in just natural inflation, natural market appreciation. So we were quite conservative there, and inflation has pushed values up more around 6 to 7% per year rather than 1.5. So we are realists here. We understand that's helped our value grow. That's helped our rental prices grow. We've also executed our reposition successfully. We completed our budget, our renovations on budget and on schedule, and that's allowed us to release the property for top dollar and achieve our refinance faster. But the wind on our sales was also the market and inflation, which is a whole other reason to invest in real estate, because in a high inflationary market, real estate fares quite well. We're seeing that today. Here's a little walkthrough of the unit. Okay, our property manager makes a video of each unit when we are walking through. And so we try to, of course, do all the things we can to market out our units with videos and pictures, and we often have tenants lined up already. Here's the kitchen. You can see we got to put the stove in there. Nice walk up there, but just a fresh overall renovation here. Nothing crazy, not breaking the bank. Fresh floors, new paint, fresh trim, new vanities. Okay, and sometimes you go a little above and beyond, like in our unit, on our property in Rahway, we just put in these really cool faucets that are actually like motion controlled, so you can like wave your hand in front of it and they start going. So definitely a higher end faucet, but we put that in, and you can see our baths here. We do our kitchens and our baths really nice, all right, because that's where people are spending a lot of their time. And of course, that's where you can do very nice with finishings. You see here, the bathroom, we try to do nice finishings there, nice trim work, nice big vanity, everything fresh and new. So that is always our goal here when we renovate a property. We're not going to break the bank, but we're going to make it equivalent for what that market calls for, okay, and what that cost of rent calls for, and we'll equal or do better than those types of finishings. You can see to the left here too. I want to focus on this for a second. You see the picture here to the left. There's a new construction building going on. So that's what we look for as well. We love buying near new construction. To the back of this property is the high school. It's right up this hill. You can walk right to the high school. That's literally the high school right there. And then there's new construction going on 2 doors down. This gray building right here is actually part of our building, Summer Street. But it's always good to be buying near new construction. If you go down the street the other way, about 2 blocks, there's a big new development going where the old armory was. And to the left here is another big development going on of a new apartment building. So listen, we're not really going to compete with those new development, new construction units, right? They're going to be asking a lot more, but they're also going to be much nicer units. Let's be honest, brand new construction is always going to be better than an older renovated building. But still, in this case, we're going to underprice the competition. We're going to be putting far less of an investment into our units as well by buying an existing building and renovating what we have. And of course, then we can charge less for the units and create a very nice comparable unit, granite countertops and new bathrooms and kitchens and hardwood floors and the whistles and bells that tenants are looking for. But it's going to be at a more reasonable price. It's not going to be brand new construction, but again, that's a really attractive thing to tenants, especially if recession comes or market slowdown. Tenants that are living in the new construction Class A real estate are going to move down to Class B and Class C real estate. And that's where our buildings tend to lie. Okay, so let's go over the target returns for investors years 1 to 5 on Summer Street here. You see a before and after photo here of one of the kitchens there. So COC stands for cash on cash return. Okay, cash on cash return means the amount of cash received from an investment. So if one was to invest $100,000 and receives $10,000 in return, that would be a 10% cash on cash return. It's 10% of their investment. In this case, our goal from the refinance is to achieve about half of our investors' investment back, okay, about a 49% cash on cash return. So our goal is generally to return about half of our investors' initial investment at each refinance. That's always our goal. And in this case, our goal is to get about 16% from cash flow from the building. That's been hard to achieve on this building. With the pandemic happening, we had some slowdowns. We've been able to get it renovated quickly and leased up for top dollar, but cash flow has been a little slow for this one. And I think we'll make up for that plus some on the refinance here, it's looking like. Tax depreciation, 21%. That's panning out to be about as such. And so our investors own part of the LLC that's created just to buy a building. So they receive K-1 tax forms at the end of the year, offering tax depreciation in their investment. And that's one of the benefits of owning real estate. See, in this case, the investor is going to get more tax depreciation than cash flow, right? This is not really a high cash flow investment. The majority of the returns here, as you can see, are made from the refinance, which is realized in a lump sum liquidity event at the refinance. And we plan to get there about 2 years sooner than planned, so that cash and cash return, when annualized, is going to be much better than targeted. In this case, if you look at the tax depreciation of 21% and the cash flow at 16%, well, these investors are actually going to get more tax write-offs than they will cash flow. So they'll be able to not only write off their cash flow, but then have excess passive tax depreciation they can use to write off other forms of passive income. Now, when the refinance happens, they're going to get a large lump sum investment, a large lump sum check. Right? Let's say you made a $100,000 investment in this building, and the refinance happens, and then you receive a check for $50,000. Well, if that $50,000 was taxed, it's really like receiving $35,000. But in this case, with a refinance, as long as you choose not to exit the investment, okay, the investors do have an option then to exit the investment, get back their initial investment, keep the funds from refinance, keep the funds from the cash flow, but then they'd have to pay capital gains tax on all those earnings. So to avoid that, you want to stay invested long-term. Once we're up and done with the renovation, we've refinanced, then generally the building is cash flowing very nicely. Of course, then we refinance again about 4 years later, and we want to do that again about 4 years later after that, and eventually do a 1031 tax deference and trade into a bigger building. Bigger is better in real estate. That's going to give more cash flow, more equity growth, more tax depreciation, and that is the plan with our buildings. So our investors can stick with us long-term as we build their wealth exponentially, or they can exit at each refinance and pay the tax man. Of course, if you're invested through an IRA, that is tax deferred. So about a third of our investors use their self-directed IRA or solo 401k. If you're not sure how to do that, you can check out our website. We have tons of information on it there. We have other webinars. And in 2 weeks, I'm doing a live webinar called How to Self-Direct Your IRA to Real Estate. So if you like listening to me talk, you could join that webinar in 2 weeks. And if you don't like listening to me talk, you can go on our website and read a blog about it. We have total cash on cash return of 65%. That's our goal on this property. And we have a 5-year target here on this property as well. Again, disclaimer here, not solicitation for funds, tax advice, legal advice. But we do plan to hit our target here about 2 years in advance. And that's going to allow our investors to make these types of returns about 2 years in advance, which would be great for our investors here to earn those returns sooner than later. And that would allow us to outperform our initial targets. I see a question just came in. Thank you so much for putting that in. I'm going to answer all questions at the end here. And so I do want to, okay, we'll keep going here. Just want to make sure it's not a technical difficulty. So here's case study number 2, 196 9th Street in Passaic, New Jersey. All right, so here's a 6-unit property. Now, this one we are actually refinancing next week, and we are 2 years ahead of schedule on this one, and the investors are going to earn far better than targeted. So big success here for this property. It's a smaller property, but it's been a great investment for us. 196 9th Street, Passaic, New Jersey. Again, great deals are created, not found. This gentleman, we found them through direct mail. It worked very well back in 2018, 2019. But again, it would take multiple touches, maybe 8 or 9 letters just to get a hold of people. And then, of course, a long relationship growing time where you're building rapport, getting to know each other, understanding the landlord's goals and why they're selling the building, but also explaining to them, hey, we're the real deal. We say we do what we say we're going to do. My business partner and I have closed over 250 real estate transactions. We've raised over $10 million, helping over 50 people invest passively in New Jersey apartment buildings. And we've both been doing this over 10 years. So we have a good track record, we have good staff, and we have a good reputation locally as well. So that helps us perform on properties, especially with brokers and wholesalers, people more in the business that know us. They tend to bring us their deals first. But in this case, we met the owner, built rapport, showed them our value, learned about their reason for selling, their needs as well, right? What are their needs? Right? It's not always price. Sometimes it's an easy sale. Sometimes it's knowing that I'm not going to nickel and dime them on repair issues, or just knowing that I'm not going to get to the closing table and not be able to close, right? That's the seller's biggest fear. So by instilling confidence and finding out the seller's real needs, and his biggest need was to close pretty quickly and move down to Florida and just make sure he was going to get the amount he needed to move. In this case, he sold the building for a great price, about $450,000, which is a great price for a 6-unit, even 3 years ago. So the old owner was retiring, ready to sell. Seth built rapport with him, negotiated a good price. There was no green card, low rents, needed work. Sounds familiar, right? Pretty much the same as the last building. We don't stray far from what we know. If it ain't broke, don't fix it. We're good at buying mismanaged apartment buildings in North Jersey, repositioning with our in-house management company, and refinancing them for top dollar for our private investor group. That's it. That's what we focus on. We're not reinventing the wheel. So no green card, no problem. We got a great price on it. Low rents, no problem. We renovated the units, released them for top dollar over time. Needed work, not a problem. We're pros at this. We have a great list of contractors. We got our work done on budget here on this property. Had a little bit of damage from Hurricane Ida, but that we were able to cover that out of our pocket, so our investors, of course, don't have to. 6 2-bedroom apartments here, so smaller building, but a good investment. 45% was owned by passive investors, non-voting members of the LLC. 55% is owned by People's Capital Group. So this is an example of a situation where the price of the property, the renovation costs, all the numbers landed so that the investors are owning a little bit less than People's Capital Group here. That's normally not the case. Generally, People's Capital Group owns about 1/3 or so of ownership, and the passive investor is going to own about 2/3 or so. Depends, every deal is a little different. But the bottom line is we want to structure the acquisition so the investors are going to get the targeted returns, which are generally around 10 to 12% cash on cash annualized returns are usually our initial targets. And then, of course, we look for internal rates of return, taking into account your tax benefits, around 15 to 20%. Those are generally our targets. In this case, the structure allowed us to achieve those targets for our investor. In fact, we did far better than that. So we raised $164,000 for this. A small fundraise, small deal, but it was a great deal. A 506C, we filed with the SEC, so we actually only had accredited investors on this investment here. We got a $337,000 mortgage that was personally guaranteed by Seth and I. so that we got good terms on the mortgage, low interest rate, low cost on the loan. That's our job, to get a really good deal, but also get a really good mortgage. And purchase price, $450,000. Right? Make your money when you buy. That's our main goal. So this property, we renovated it here. Let's go over the timeline here. Timeline to close and reposition. So our cash out refinance was achieved 2 years ahead of schedule here. We're closing next week. Very good week for us and our investor group on this opportunity. So in August of 2018, Seth first connected with the owner and started building rapport. Again, through direct mail, and takes a little time. So 2 months later, the seller signed a purchase contract with Seth, and we were able to move forward on the property at $450,000, which was below market value even at that time. By January 2019, we closed on the property and we began renovation. And by March of 2019, we were able to complete our first successful cash for keys. And that means paying a tenant to move out of the property. So when you buy properties that have low paying tenants, you can't just say, hey, time to go. That's not how it works. The law is in their favor. Plus, that's unethical. So what we do when we buy property that have tenants leasing the units for far below market value, we say, hey, you've been living in this building for a while. Your unit needs a lot of work. You know it needs a lot of work. You don't seem particularly happy living in a unit that's not being taken care of by the last landlord. Now, for us to renovate your unit the right way, we need the unit vacant. So we want to understand what is the cost for you to find a new place and move to a new place. Let us help you with your moving costs. Also, in turn, you're going to find a place that you like, and you can start fresh with a new unit. And again, we'll help you with your moving costs and give you your security deposit on the way out. So that's a cash for keys. Some tenants would negotiate $1,000, $2,000, $3,000. Other tenants don't accept our cash for keys, and then they don't pay rent. So they end up in eviction court, which costs us a lot less than the cash for keys, but there's still a cost to that as well. And we prefer not to go to eviction court. It's not good for the tenant. It's not good for us. It's a cost and a hassle as well. And you tend to get a more beat up unit. By doing a cash for keys, it's an amicable exit. It's a nice exit of the tenant. You get a nice unit at the end of the day. It's generally not destroyed because it's an amicable exit. So we worked out a number of cash for keys on this building. We also had a couple other tenants end up in eviction court, and a couple other tenants just kind of naturally move out. It was kind of interesting. We offered a cash for keys to all the tenants when we first bought the building. Only about half of them took it, which is pretty much what we estimated. And then the other tenants just kind of cycled out over the next couple of years, not getting a cash for keys. So it was an interesting turn of events there. But we were able to lease up each unit for top dollar, renovate each unit as well. And we completed we're completing the refi cash out right now. It appraised for $730,000. So we bought the building for $450,000 3 years ago. We invested about $50,000 in renovations. So, you have closing costs, other holding costs. Okay, fine. But it produced a little bit of cash flow along the way. But for the most part, we were just covering our costs. But now the property is worth $730,000. So, maybe with holding costs and acquisition costs and everything else, you could say we're into it for $550,000. So $730,000 appraisal value 3 years later. It's phenomenal. So the market is our wind on our sails for sure, but we also executed a nice reposition. We were able to get the property value up very strong over a small period of time, get the property cash flowing as well. And now we're completing a cash out refinance where our investor will expect about over half of his investment back there. Our investors in general will expect about half their investment back here. And we're going to achieve that return on investment 2 years early. So we're going to far exceed our initial annualized, our target cash on cash return here. Because we're achieving that refinance early, our investors are earning a higher annualized cash on cash return. So it's good for everyone. Okay, reposition performance. So here's some more details on this 6 unit here. So we have an initial rent roll of $4,920. We have a target rent roll after 3 years of 7,300, and our current rent roll after 3 years is 7,500. So we're able to more than achieve our target rent roll. Our construction budget was 20,000. We actually ended up putting more than that into it. I don't think we put actually 50. It was more around 30 to 40,000. So our construction budget was very, very light for this one. I believe we underestimated the construction initially. There were some more challenges once we started doing some renovations throughout the property. And I think off the bat, we probably got too low a quote from our contractor as well. So some challenges there, but overall, we were able to complete our renovation. We were able to complete it on schedule as well. And here's a quick walkthrough of the unit here, just to show you what type of renovations we like to do to our properties. Little kitchen there, nice trim work. I'm just trying to make them pop and make it really a nice place to live, nice and clean and safe, up to code. And all right, so our construction budget here was again a little low here, but we had a 6% annual forced equity growth. Our target was achieved. We also assumed a 2% natural market appreciation, but our values grew much faster than that. So that was the wind at our sails that allowed us to achieve our cash out refinance on this very successfully. Okay, let's break into our third case study here. I'm moving a little slow. We'll try and speed this up here so we can get everyone back home here by 8 o'clock. Our total targeted returns for investors for this property here in Passaic, New Jersey. Oh, this final slide here was 53% cash on cash return. Looks like we're going to be achieving that. Cash flow was 2%. That was achieved as well. Again, very low cash flow here. We're not ambitious on the cash flow. Tax depreciation, 11%. So more tax depreciation than cash flow. That allows our investors to write off their cash flow and have excess tax write-offs to write off other forms of passive income. If the refinance is not taxable because it's debt, as long as the investors don't exit the investment, that's non-taxable income. It's debt that Seth and I will sign for. Our tenants will pay it down for years to come with a professionally managed property. But the cash out refinance strategy is a tax strategy, allows you to pay essentially zero taxes on the funds you're collecting here as long as your cash flow is equal or less than your tax depreciation. So adding up all those returns, that's going to achieve about a 66% internalized rate of return. And if you just take our cash on cash return, that's the cash flow plus the refinance, it's going to give you about a 55% cash on cash return. And this has been achieved here in about a 3-year period. So our investors' cash on cash return, when annualized, was about 50% higher than target. So great success story here for our property in Passaic, New Jersey, and our investors there are going to be laughing all the way to the bank. So quick update, 105 Marion Street in Patterson, New Jersey. Okay, we closed on this about a year and a half ago. We'll do a brief update here. This is a 25 unit with a full parking lot. It was renovated throughout when we bought it, although some of the units do need renovations as tenants move out. The units have been a little beat up with wear and tear. Rents were about 15% below market value. So this was different than the last two properties we talked about, right? This was not a huge renovation strategy. This is a much lighter renovation strategy, much less heavy lifting going on, more renegotiating current tenants, current leases, working with the tenants that are already in the building, doing minor renovations when tenants move out of the building or what are turning out to be a little bit larger than as the units have been a little more wear and tear and on some units than originally planned. But overall, we've been on budget here. We've been on schedule. Our units are leasing for more than we targeted. Property values have grown and more than targeted, and rental prices as well. So been a very good investment so far. Renovations are on track. Rents are above target. And the property value is ahead of target as well. So I think we're going to achieve our refinance in about a 3-year to 4-year period on Marion Street as well. And again, that's going to allow our investors to make that targeted return in a faster period of time, therefore building their return on investment, their annualized return on investment, allowing us to beat our targeted ROI. Here's another quick update, 421 Central Ave in Newark, New Jersey. This is ahead of schedule. This is a 7-unit mixed-use property, again, a bit on the smaller scale. The last property was a 25-unit. That's more of our preference. We just bought a 27-unit in Rahway, New Jersey. But these are good deals as well. These 7 units and 6 units, you can do well with them also. Construction's on schedule. We had a little cost overage due to Hurricane Ida, and the refinance number 1 was complete. So we bought this with a hard money loan, a construction loan. We did our renovations. We refinanced 1 year later, and we got a bit additional cash as well to complete our renovations. And we are now completing our last 2 renovations on this property. We're leasing up the units for top dollar, and we hope to refinance this in about 1 to 2 years, which would be way ahead of schedule. And our rents are on target, if not a few ticks above target, and we're likely to cash out soon here in the next 2 years. So really looking forward to completing that renovation as well, completing that project. And all of our projects right now do appear to be a bit ahead of schedule as far as values and rents go, because the market's been very strong. We've also been able to execute very nicely with our in-house management company. Doing this for so many years, having our infrastructure in place ensures that we get these projects done quickly and on budget. So here's our revenue model. Okay, our passive investors enjoy 3 types of income. We focus on quarterly cash flow, which is not the main moneymaker on these buildings. It does take time to get quarterly cash flow coming out of the building, especially for big renovations, right? When we're renovating a building, moving tenants out, moving tenants in, there's vacancies, there's costs to that. So it slows down the cash flow, where a property like Marion Street produced cash flow from our first full quarter of ownership. So that's nice to see. So every project's a little different, but the bottom line is you're focused on a 3 to 5 year cash out refinance. That's a large liquidity event where our investors would expect about half of their investment back at the refinance. That's always our goal. We want to try to get there as quickly as possible as well. And of course, you have annual tax depreciation. So that's because investors own part of the LLC that's created just to own the property. That means they get a K-1 tax form at the end of the year, offering them tax depreciation, and that allows them to write off their cash flow on the property and essentially have a no tax investment here. Right? As long as you stay invested long term, it's a no tax investment because the cash flow is written off of tax depreciation, and the refinance is a non-taxable liquidity event if you stick with us through a 1031 tax defense. So why now? Why are we still investing in real estate? Why are we still buying buildings? People ask it all the time. Why don't you wait for values to go down? Well, I had people tell me that in 2016. Someone told me that in 2017, 2018. And if you waited for property values to go down, you would have lost about 40% of your growth. You'd be paying about 40% more right now. Yes, the market has done well. The market is in a seller's phase too, but there's so many forces right now forcing real estate values up that I'm not very bullish on a lot of real estate departments like office space, retail space, or residential housing like single family homes. But apartment buildings are very tried and true. And if there is a recession, people generally rent more. And buying in high demand markets for good prices when you buy ensures, with all the population growth in North Jersey, that we have consistent demand for our rental units because we make them nicely renovated. We make them look nice and smell nice and market them well, and we price them at an attractive price as well. Because remember, we're not new construction. We can underprice the new construction because we're buying for lesser and we're renovating for a lesser cost as well. So why invest in real estate now? Well, it's quite simple. Rents are growing, interest rates are low, property values are growing. There's a shortage of housing, especially in New Jersey. Shortage of residential housing. We all need a roof over our head. It's a commodity. It's something we all need. It's a necessity. Housing demand is continuing to grow, and inflation. That's the wind at our back here, or wind on our sails here, that we see as a landlord. Inflation lowers the cost of our debt and builds the value of our real estate. So it's a perfect storm. It lowers the cost of our debt. It builds the property value that allows for more equity, that helps us achieve the cash out refinance in a quicker time, therefore exceeding expectations and earning stronger returns for our investor group. So right now, it is a good time to invest in real estate. And we're continuing to be very, very picky on what we buy, but we're buying in inner city areas and high growth areas in New Jersey. And we continue to buy there, and we're always looking for a good deal. In fact, the hardest part of our job is finding a good deal. Once we find one, it's funded quite quickly. And to get on that list, you want to go to peoplescapitalgroup.com and fill out a qualification form, start your qualification process. But let's talk briefly about how to invest in an IRA, and then we'll wrap up here and we'll answer questions. So invest with an IRA, grab the bull by the horns. It's easier than you think. About a third of our investors take their IRA or solo 401k and self-direct it into real estate. It's a few $100s to start an account with a self-directed IRA custodian. The process is quite simple. You reach out to an IRA custodian. There's dozens of them out there. In fact, we can put you in touch with someone who can help you select the right IRA custodian for your needs. And so once you select that IRA custodian, you'll then hire them to be your custodian and fill out the paperwork, and they're going to contact whoever holds your IRA right now, say Fidelity. So let's say you hire Next Generation Trust as your IRA custodian, and then your IRA is held with Fidelity. And you say, you know what, I want to take 30% of my IRA and I want to invest it in an apartment building with People's Capital. They have a good reputation. I like their business model. It's tried and true. And they have an in-house management company, which gives me an added level of security. So I'm going to invest and diversify out of the stock market into real estate. Not all your money, but part of your capital invested in the stock market should be invested in tried and true assets like professionally managed high demand real estate. It's not from People's Capital Group, but a real estate syndicate in general that has a good track record and a good strategy that you agree with. Select that investment option and go with it. And I always suggest to my investors, about a third to half of your investment capital really should not be in the stock market. Should be somewhat in professionally managed real estate and other assets as well, but primarily professionally managed real estate. So by self-directing some of your IRA or solo 401k out of the stock market and into real estate, it's not a way to pull from it early or cheat the tax man, but it is a way to build your IRA faster. So once your IRA custodian then calls Fidelity, they move the money from Fidelity to the IRA custodian, then the IRA custodian will reach out to us, request a number of documents. We're very IRA friendly. We work with a lot of IRA custodians. We know what they're looking for. We offer it. And then the IRA custodian can allow you to invest your capital into an apartment building with People's Capital Group. As the building produces cash flow, that's going to be paid back to your IRA custodian. So build your IRA custodian account there. And when there's a big lump sum upon the refinance, again, back to the IRA custodian. So it's not a way to pull early or anything like that, but it is a way to build your IRA faster and diversify out of the stock market. And that's why about a third of our investors choose this option. And we encourage it if your IRA is 100% invested in the stock market, that might not be the best way to diversify your nest egg. So let's go over 3 types of investors we like to work with, and then we'll answer questions here for the evening. So we like to work with high income investors. These are accredited investors. These are individuals with large stock portfolios, primarily that are earning stock dividends. Cash flow is similar to a dividend. However, cash flow can be written off with tax depreciation, where a dividend or a stock does not offer tax depreciation. So one of the biggest benefits of investing in real estate over the stock market is tax depreciation, which we make sure our investors earn on our investments. And we also have a tax strategy really in mind with the buy, renovate, refinance strategy. It's really a tax strategy. Returns are less predictable in the stock market. We do feel they're more predictable in real estate. And we do feel well-managed, high-demand real estate, apartment buildings in North Jersey are more recession resilient than the stock market. We also like to work with active real estate investors. These are people that maybe own a few properties. Maybe they own some duplexes and triplexes and some bigger properties as well. And they're dealing with management companies, or they're managing it themselves and they're pulling their hair out. And they're realizing that there's a lot of work behind the scenes. Even if you have a manager in place, you're still responsible for that manager. It's not really a passive investment. Plus, I've hired property management companies that didn't show up or took money from us and were scrupulous, right? So hiring a property management company to manage your portfolio doesn't mean it's like, oh, I'm done, hands off, just send me the check. That you do have to be hands-on, you do have to keep an eye on them. And quite frankly, what I saw was that a management company is not going to manage your baby the way you want it to be managed. So we developed our own management company, and that's been our strongest asset ever since. So often people who own properties say, hey, you know what, I kind of want to work less and earn more. If they're invested in our real estate syndicate, I've gotten feedback that they actually earn better returns through our real estate syndicate than they did from the properties they own 100% of, because those are smaller properties, and smaller properties are harder to make big earnings on. It's easier to make high earnings on larger properties and more units under one roof because you have economies of scale. So by investing passively with a real estate syndicate, active real estate investors can become truly passive real estate investors, not managing the building day in and day out, not signing for the mortgage. They can own bigger properties with a smaller investment amount by owning a piece of the property, investing through a real estate syndicate. Tax time is made much easier as well with our CPA, filing the K-1, our bookkeeper as well, taking care of all the bookkeeping and financials on a quarterly basis. And of course, it's a whole third-party tax company and CPA firm that does all that. So it's a nice separation of powers as well. And of course, they're never on call for managing the property, which is one of the biggest headaches of being a landlord, is dealing with a management company or dealing with tenants and toilets. The third type of investor we really like working with is an IRA or solo 401k investor. Again, this is someone who's decided to diversify some of their IRA out of the stock market into real estate. Generally maybe a third or 50% of their IRA or solo 401k into real estate, depending on their appetite for it, of course, sometimes more. What we see here with the IRA investments, a lot of times in the stock market, they're hit with a lot of fees. We don't have a fee-based syndicate. We essentially charge only two fees. We charge an acquisition fee upon closing, which is a success fee, and we charge a property management fee, which is about 2/3 of what your normal property management company would charge. So we charge a discounted property management fee, which is a fee we'd have to pay for anyway for any property management company. But by controlling our own company here, we could charge a discounted fee. We do not charge an assets under management fee, which is a general overriding charge of funds raised. We don't believe in that. Seth and I believe we should get paid when our investors get paid. We should only get paid if we perform, if we're producing positive cash flow, if we're getting the property refinanced and get valued at the right price. So we only eat if we do our job properly, we get the property to perform. That's very important to understand, that aligning of interests. We're not a fee-based syndicate, we're an equity-based syndicate. That means we get paid through equity, not fees. So we have to do our job. We have to produce cash flow. We have to hit that refinance mark. We have to get there in a timely manner to put food on our own plate. And that's a nice incentive to make sure that our values align with our investors' values. Of course, we feel that it's more recession resilient than the stock market and more predictable as well. But what a lot of our IRA investors say is they love making a difference in the inner city community, which is really nice as well, right? We buy in Newark, Patterson, Passaic. We went over a number of properties today in those areas. And by investing in inner city areas, you can actually make a difference with your money, and actually allows you to see a small difference in that property. And it's really nice. And by improving that one building and that one block, maybe you're helping that city just a little bit. Maybe you grew up around Newark or Patterson, and it makes you feel nice to know that you're improving a poorly run property there that maybe previously was run by a bit of a slumlord, and now it's being run by People's Capital Group, and we're really managing it well. It's a nice place to live. It's a safe place to live, and you feel proud about that real estate, but also you're helping inner city communities one brick at a time, and that's a nice feeling. And I really get pleasure out of that part of my job as well, and a lot of our investors do also. So here's some client satisfaction. Most of our investors reinvest over time. In fact, 9 out of 10 of our investors reinvest over time with us because we often do better than targeted. Tim Carey, 5-time investor. I continue to grow my investing relationship with People's Capital Group. They have a great history of buying properties at a good price and offering value. This is Frank Pacuzzi, 4-time investor. My investments have been on point, and I like not having to manage the properties. Chris Salerno, 6-time investor. I've been investing with People's Capital for nearly 5 years now. Could not be happier with the process and the returns on my investment. Aaron and Seth and the rest of the crew are fantastic to work with. They're like clockwork in their updates, communications, and payments. Great company. So that's it for us tonight. I'm going to answer some questions here. If you want to learn more, though, and start the qualification process, go to peoplescapitalgroup.com. You do have to fill out an application there. And then once we receive your application, we'll reach out to you to set up a discovery call. That's about a 15 to 30-minute call with a managing member of People's Capital Group. We're going to go over your questions and make sure you understand exactly what we do here at People's Capital Group, and understand your investment goals and see if they align with our investment goals as well. And if we're a fit, then we'll send you the qualification form and make sure you qualify to invest as a sophisticated or accredited investor. And then once you fill out that qualification form, granted you are qualified, then you can review any upcoming opportunities. But we cannot send opportunities out to anyone that doesn't fill out that qualification form, that doesn't go to peoplescapitalgroup.com and fill out the application So if you want to review our current offerings, our upcoming offerings, and just follow us more closely, go to peoplescapitalgroup.com, fill out the application. We'll get in touch with you to schedule your discovery call, and we'll connect. You talk with me, Aaron Fragnito. We'll talk about your investment goals and see if we're a fit. Hopefully we are. All right, so let's go over the questions here. Here's a question. What are the name of the banks you use for mortgage and cash refinance? We use all different types of banks and brokers. I like Lakeland Bank. I'm doing a refinance with them right now on the 6-unit. New York Community Bank I've worked with. Connect One is a good one. Credit unions, I like the Financial Resources Federal Credit Union. And generally in credit unions are pretty good as well. But those are a lot of the banks we work with, and we have good relationships with banks and brokers. Marcus and Millichap Finance is another broker we work closely with. So really been building those relationships for years. See, it's important to have relationships with brokers to find deals, but also mortgage brokers and banks to find money at a good price, right? Because there's two parts to a real estate transaction. There's the price you're paying for the real estate, which is super important. You want to get it at a good price. But there's also the price you're paying for the debt, for the mortgage. That's very important as well. If you're paying too many points there or too high an interest rate, and not working with the right banks that are reputable, maybe they waste your time, collect a fee and don't close. So you want to make sure you're working with reputable banks, getting the best rates on your debt. And that's what we do here at People's Capital Group. We shop around for the debt just like we would for the real estate. That's our job, to make sure we get really good competitive debt rates. And we do that with our relationships as well, by working our broker relationships with banks. Okay, so here's a question from Gary. Are the construction costs coming out of your own pocket? So no, we raise the construction funds off the bat. Okay, whenever we're looking at a deal, we say, okay, we need capital for the down payment, closing costs, operating reserves, construction costs, and acquisition fees. Those are the funds that we're raising for closing. And we make sure we raise all that capital. We estimate how much we need for all that. Now, here's the hard part. Estimating construction before you go in and start opening walls, right? We have to estimate how much construction funds we'll need. We don't know how many tenants are going to move out a lot of times. We don't know how they're going to leave the unit. We don't know what's going to be behind those walls. We don't know if a hurricane's going to come and flood the basement and the property's not in a flood zone. All these things are out of our control. Some of them are slightly in our control, but for the most part, we are just trying to move the pieces of the project along as best we can with our experience in mind. And the bottom line is, if construction costs go over what we budgeted, we don't go back to the investors for a cash call. We invest our own capital to make sure that those construction costs are covered and construction can continue. Now, we do this because we figure it's our fault if construction costs go over budget. We're in charge of making that budget. We're in charge of managing the construction and the contractors. So we need to make sure we stay on budget. We do cushion the construction a little bit, but there are times that it goes over our assumption, over our budget. So if that's the case, People's Capital Group will come in with excess funds to cover those construction costs. We do not take additional equity for those excess funds. We simply are returned those funds upon the refinance of the building. That's how we cover those excess construction costs, to make sure we never go back to our investors for more capital. We never do a cash call. And that's a good way of keeping us honest when it comes to budgeting those costs up front, and also managing the contractor and the project long term, making sure we stay on budget there. All right. Here's another question. Is there a copy of the webinar? My partner and I did a similar deal in Hartford, Connecticut. I'd like her to see this. Yeah, absolutely. So this is actually live right now on Facebook. So this is on our Facebook group, Real Estate Investments. Definitely check us out on Facebook, Real Estate Investments. And that way you'll see this right there. You can also join our Facebook. Our Facebook group is actually called People's Capital Group. Our Facebook page is called Real Estate Investments. So again, the Facebook page is Real Estate Investments. Facebook group is People's Capital Group, Investor Community. I'm also going to probably send this out also through email next week. So keep an eye out for that. If you got the email to join this, you'll probably get an email next week with the recording of this webinar as well, and an invite to our next upcoming webinars and events. So keep an eye out for that email. And if you want it sooner than that, you can go to our Facebook page, Real Estate Investments. Okay. All right, so I don't see any more questions right now. It looks like that's it. So I'm glad we had a good turnout here tonight. I'm glad everyone was able to, it looks like stick around for the entire presentation here, which is a good hour. Hopefully you learned how we reposition apartment buildings in New Jersey and how we help people invest in real estate. Again, we have a very tried and true strategy. We stick to what we know, and we have a proven track record. So if you want to learn more about how people get qualified to invest in People's Capital Group, you want to start building your wealth with us in high demand New Jersey apartment buildings, go to People's Capital Group tonight, fill out the application there. We'll get in touch with you to move to the next steps, and hopefully you're qualified to invest in People's Capital Group. I look forward to connecting with you on our discovery call, and you can all start that at peoplescapitalgroup.com. Have a good night.